Welcome. Today is August 11th. I'm Jeff Hughes, Chief Investment Officer at JWH Investment Partners and editor of Alpha Insights. And this is your Daily Five. Daily Five is the show where we take a look at 5 charts that really stand out in our mind as being important. So let's take a look at the first chart. First chart really reviews the 2021 Cycle Composite that we've been talking about for some time. And I think on the last Daily Five show that we hosted, we also featured this chart. And at the time, the market was down toward its July lows. And our postulation at that point was that the market was likely to experience some form of a melt up. And at the time, we were favoring technology stocks as being the leadership. And that played out actually pretty well. Now, the Cycle Composite reached its pinnacle or its peak for the year on August 6th. That was last Friday. And while the market made its all-time high on August 6th, it has proceeded to make further highs and is actually at a new all-time high today as we speak. Now, we've marked the chart. You are here because as the Cycle Composite goes, we've reached the highs that we expect to see. And the S&P 500, which is represented by the dashed yellow line, is actually tracking the Cycle Composite line, which is in blue, with about a 90% correlation right now. Now, what we're looking for is for the market to turn its trend to the downside really for the next 3 months. The peak here in August turns hard down into late October before we get some form of a sideways move expected. And essentially what we're looking at here is this combination of cycles, the seasonal cycle, which is a 1-year cycle, the 4-year presidential cycle, and the 10-year decennial cycle. So that's where this forecast comes from. So the idea going forward is that the market has probably seen its highs within kind of this range. And we've been calling for a target of around 4550 to 4650 for some time. We're not certain that we're going to hit that target this year, but we're not ruling it out either. But going forward, we want to pay attention to the cyclical nature of the market and really the seasonal nature of the August, September, October period. So with that, let's take a look at chart number 2. Chart number 2 really looks at the historical performance of the August, September, October period, which is historically the worst performing 3-month period of the calendar year. Now, we've looked at data going back to 1928. And when examining that data, it turns out that the S&P 500 index has produced an average performance of about 0, essentially, for that 3-month period on average, with a median performance of just around 0.6%. Now, in all, about 55% of those periods were positive and 45% were negative. And the best performance achieved during that 3-month period was a 24.86% gain, which occurred in 1982, right as the market was lifting off into its 39-year secular bull market. The worst performance produced during this 3-month period was a negative 26.36%, and that occurred back in 1937, pre-World War II. Now, what we've done further is in the table, we've isolated that August, September, October period to focus only on the years in the decennial cycle that end in the number 1. So 1931, 41, 51, all the way through 2021 this year. And when we look at that data, we see that performance is notably worse. The mean performance is down negative 5.5%, with the median a negative 3%. More importantly, the high was only 2.8%, where the low was negative 24%, and only a third of those periods were positive, where 2/3 were negative. So we happen to be in a period that is both, historically poor performing seasonally and historically very poor performing from a decennial perspective, from a 10-year cycle perspective. So with that, we want to take a look at what the market's actually doing right now as we head into this period. So let's take a look at chart number 3. What we see is that there's a notable shift from cyclicals into defensives over the last 21 trading days. And 21 trading days is about a month. So we're looking back a month from yesterday's close. And what we're seeing is that, staples, healthcare, and utilities are among those sectors outperforming the market. And we can throw in there materials and financials, which are benefiting from an upside move in interest rates. But most importantly, and top among the performance in this period has been the utility sector, which has outperformed the market by about 330 basis points over these past 21 trading days. So what that tells us is that, market participants are noticing a shift in the fundamentals, most likely. And this is consistent with the cycle. And the fundamentals that we're thinking about right now is that growth has come in at an exorbitant rate. In fact, far above expectations. Earnings are growing well above 85% this quarter. GDP was very strong. We're seeing very strong job recovery numbers. And what is going through investors' minds at this point is that they're asking this question: are we seeing peak growth right now? Is this as good as it's ever going to get? And if that's the case, can the market continue to go much higher from here? And the answer is the market can go higher because earnings will continue to grow, but just not at the robust pace that we've experienced. Yet market participants are starting to kind of question this. And when they ask these questions, they take actions that support them and that shift away from cyclicals like energy and industrials and to some extent technology and into defensives like utilities is kind of the way investors are expressing that concern. And so it prompts us to take a deeper dive into utilities. So with that, we'll take a look at chart number 4. And what chart number 4 does is it examines the performance of the utility sector. This is the SPDR's utility ETF that we have on the chart here. And we're looking all the way back to the 2009 lows. And when we take a trend line and just mark the monthly closing lows going back to 2009 to present, we see a pretty discernible and steady uptrend that has been sustained since 2009, with many, many touch points along the way that have held or challenged this trend line successfully and advanced further. And where have we been since the March 20 lows? Well, in March 20, we pierced that trend line pretty substantially, but closed above it on a monthly closing basis and have continued to hold above that trend line on a monthly closing basis going forward. And so, when we think about utilities and where we're at right now in this juncture, utilities are actually the only sector in the S&P 500 that has not posted a new all-time high in this recovery off the March 2020 low. However, it now appears that might be changing. And we've added another trend line off the monthly closing highs going back to February 2020 and the most recent closing high. And what we're seeing is that utilities appear to be challenging those highs. And if we were to close out the month where we are today, and there's still another 3 weeks to go almost, so we'll see. That would definitely confirm a shift in character in this consolidation that we've experienced since February 2020. And the breakout above that descending trend line off the prior closing highs would thus resolve a consolidation pattern or lateral consolidation pattern of the symmetrical triangle variety. And we believe, just based on the characteristics of this breakout, that it is probably going to resolve favorably. Anything above, say, $67 on a monthly close would resolve this on a favorable basis. And from that level, we can actually project a fairly substantial advance for utilities going forward. But what we'd rather do than just play the group itself is try and identify a stock or more, several stocks preferably, but one in particular that's outperforming not just the utility sector, but outperforming the market as a whole. And so with that, let's take a look at chart number 5. And what we've attempted to do here is take a deep dive into the constituents that make up the utility index and identify one or more stocks that stand out. And the one that really stood out to us as having extraordinary momentum and relative strength outperformance potential was NRG Energy, the symbol being NRG. Now, last week, the stock closed at a new all-time weekly closing high and posted a bullish inflection above its key weekly resistance of $43, which went all the way back to 2019. And so from that, we can evaluate the pattern of price and recognize that there's a classic pattern-based formation of the inverted head and shoulders variety that is evident in the price action going back the last 3 years on a weekly basis. And overlaying the fact that we've got very strong momentum and accelerating relative strength, and we can see that in the lower panel where this RRG chart points out both its relative strength on the red line, which is about to pass above the 100 or break-even level, if you will, following strong momentum. We think that we have a pretty high probability of seeing follow through here, which we project using this price pattern, a potential measured move to as high as $66, which would translate into an approximate 50% gain. Now, there's no definitive time horizon for this gain to be achieved, but just given the rapidity of the breakout that we're seeing here over the last several weeks and the strong momentum, we think the resolution can take place relatively quickly, and we could see a large portion of that gain realized in the next 1 to 3 months. We've advocated an initial stop loss provision at $38, and that would establish a very attractive 5-to-1 positive risk skew on NRG. So with that, we'd like to suggest that investors exercise caution over the next 3 months, perhaps trim back equity exposure, reallocate assets toward utilities and more stable defensive names. And in particular, we like NRG as a standout within that utility space. And with that, we want to wish everybody happy trading and very good luck over the next several days. If you'd like to get in touch with me directly, you're certainly welcome to do so. You can find me on my website at jwhinvestment.com or on LinkedIn under Jeffrey W. Huge CMT. I'm also on Twitter at Alpha_Insights and on the trade exchange as Alpha Insights. So thank you very much for watching our show today.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.